excited about today's speaker as one of the list of folks that we've been having in on these Zoom chats, and just the opportunity to get some time and pick the brain of some of these wonderful investors and authors has just really been exciting to me, and I hope to you as well. So our guest today is Mohnish Pabrai, and the Pabrai investment funds were inspired by the original 1950s Buffett partnerships and are a close replica of that original partnership with its rules. The Pabrai Fund's managing partner is our speaker today and is an ardent disciple of Warren Buffett and closely follows his principles on value investing and capital allocation. From inception in 1999 through December of 2020, a $100,000 investment in the Pabrai funds has grown to over $1.4 million after fees and expenses. The funds have beaten the Dow, NASDAQ, S&P 500, and the vast majority of mutual fund managers over the long term. Mr. Pabrai, before being an investor, was the founder and CEO of TransTech, which was an IT consultant and system integration company. He founded that in his home in 1990. He bootstrapped the company to over $20 million in revenues before it was sold in 2000. TransTech received the Inc. 500. It was recognized as an Inc. 500 company in 1996. Mr. Pabrai has been profiled in Forbes and Barron's. He appears frequently in CNN, PBS, CNBC, Bloomberg Television, Bloomberg Radio. He's been quoted by various leading newspapers, including USA Today, Wall Street Journal, Financial Times, Economic Times, Times of India. He's an author of 2 books on value investing, Mosaic, The Perspectives on Investing, and The Hondo Investor, which many of you are or have read. And that's been translated to many different languages, including German, Mandarin, Japanese, Thai, Korean, Vietnamese, and Spanish. Mr. Pabrai is the winner of the 1999 KPMG Illinois High Tech Entrepreneur Award given by KPMG, State of Illinois, and the city of Chicago. He's a member of the Young Presidents Organization. He's founder and chairman of the Dakshana Foundation, which is a public 501(c) corp that focuses on poverty alleviation through education. They alleviate poverty by identifying brilliant but impoverished teenagers and providing intensive coaching for the IIT and medical entrance exams in India. He loves playing duplicate bridge, and he also was recently received a lifetime ban for playing blackjack at one of the Las Vegas casinos because he was winning too much with his system. We might have to have him back and talk to us about that system sometime. But here's a gentleman who's not only an accomplished author, investor, entrepreneur, and philanthropist. And I'm excited to introduce Mohnish Pabrai to the class. So with that, I'll open it up for some opening comments, Mohnish, and then we can go into some Q&A whenever you like.
All right. Well, that's wonderful, Eric. Thanks for that generous introduction. I used to run a IT services firm in Chicago in the 1990s, and maybe around 96, 97, we had hired the first couple of IU grads, kind of young kids who were out of school maybe a year or two, and I was really impressed with them. They were really good. And so I asked them, how can I get more of you? And they said, we should go on campus and recruit. And TransTech was growing really fast at the time. We were hiring almost like one person a day. And so we set up a campus recruiting program at IU. And for a few years, I accompanied them to Bloomington, and those were some fun trips, and we did get some more IU talent, which was wonderful. So I had a little bit of a intersection with IU, maybe close to a quarter century ago. But yeah, happy to be here and looking forward to the session. So please, whatever's on your mind, let's go through it.
All right. So basically, the way, because it can be kind of tough on these Zoom sessions to hop in, I've got some questions that you guys submitted. if you'd like to ask a question, just throw something on the chat and I can call on you. So don't be shy about that. But I'll start us off with a couple of our students. I kind of aggregated some of the questions if they were similar. And Sean Mahan in our Kelley Direct, Jay Gorin in the MBA program wanted you to talk a little bit about just given all the investment opportunities out there, how do you identify which ones you want to dig in on further before deciding what to buy? So, what types of screens might you run? What are there multiples or ratios that you really favor or avoid? How do you go from this huge universe of stocks to the ones you're actually going to spend your time on?
Yeah, that's a good question. And well, there are a number of different ways one can go about it, a number of different ways I go about it. One needs a system where one can eliminate large swaths of companies where each company doesn't take more than a few seconds or maybe a minute. So when I look at a business, the first question that's going through my head is it within my circle of competence? And a lot of companies would disappear based on that question. There are also entire industries I don't have much interest in. So US healthcare is very corrupt and does not operate with market forces. And so, pretty much anything in US healthcare, I either consider outside my circle of competence or no interest. So, if there's a biotech company, if there's a hospital, if there's a pharma company, if there's some, uh, CVS, Walgreens, that sort of thing, I'm basically, generally speaking, not interested in those kinds of businesses. So, it's a very quick pass. Similarly, for defense contractors, I'm a little skeptical about the kind of the long-term nuances and whether things are as clean as they should be and so on. So not of much interest. And also, a lot of tech names tend to be high flyers, and they tend to lose me on valuation and such. So even there, we're done pretty quickly. I mean, if I look at Snowflake, it would take me like about 15 seconds to move on. And so a lot of things get eliminated relatively quickly. There has to be something that's drawing me in. So one of the things I do is I look at Value Investors Club, and they have thousands of companies posted on the club, and people are continuously adding ideas. Generally, that is a somewhat filtered list because there's a lot of restrictions on who can post ideas and the rules thereof. So it's a good place to go hunting. It's also a very good place to learn because many of the write ups and then the comments are very insightful. So, Value Investors Club is one possible source, Value Line is another source. I have a subscription to Sum Zero, which is another source. And then I typically get several investment ideas emailed to me pretty much every day by folks across the world. And I look at those as well. And again, many of those may not fit for a variety of reasons. But when you go through all of this, some ideas and some companies stick out, and then I'll spend more time on them. The objective when I'm looking at a business is to, as quickly as possible, say no and move on. So if I can say no in 15 seconds, that's great. In some cases, it might take a minute. In some cases, it might go to 15 minutes. And then I might say no. In some cases, it might go to a few days. But the idea is that to be really good at saying no. So the business should be able to convince a very deep skeptic that it deserves more time and a spot in the portfolio. So that's generally how I go about it.
As a follow up, one of our students, Justice Boyce, you mentioned your circle of competence. How do you kind of balance the idea of circle of competence and diversification within your portfolio?
Yeah, so I don't think one needs to be, so one would not compromise on circular competence for diversification. Diversification actually is overrated. And if you look at most entrepreneurs, Sam Walton and others, through their entire lives, they had no diversification and they didn't have any sleepless nights because of that. So there are also examples. I always give the example of Charlie Munger's friend, John Arriaga, who only invests in real estate within 2 miles of the Stanford campus, and he's a billionaire. And his circle of competence is extremely narrow. It's not even real estate, it's real estate in a very specific geography. And if you looked at his portfolio, you would say, well, this looks very concentrated. But that has not stopped him from doing extremely well. So even if you understand just a couple of things or a couple of industries or even a single industry, and your portfolio was focused on that industry or even focused on just two or three stocks, as long as the competence is solid, one should not be compromising to get more diversified.
Could you just touch on, where how do you, judge if you're, as you're trying to look through your circle of competence, where you feel that you have competence and not what kind of level of knowledge do you have to feel like you get to in order to feel comfortable that that's included in your circle of competence?
Yeah, so to ask the question is to answer it. So if you find yourself asking yourself the question, is this within my circle of competence? I can just make it very quick for you. It is not. And if you find yourself asking a question, what is this business worth? Again, it's not within your circle of competence. So if something is in your circle of competence, you would know it really well. You would know the two or three variables that would drive most of the outcome in the long term. The valuation of the business would be quite apparent. And so it is very important to stay dead center in your circle of competence. Usually there is not a fine, clear boundary between competence and incompetence. So as you move away from the center, the degree of competence goes down and the risk factors on investing in those businesses goes up. So as close as you can stay to the center of your circle of competence is the critical part. So don't be concerned that you don't understand many things. I'd say I probably don't understand 99% of stocks, and I'm not particularly breaking out in hives about it. And so you don't need to understand a lot of things. You just need to understand a few things well and stick to those few things.
Great. Chris, Morton asked a question in chat. Are you able to ask it or do you need me to ask it, Chris?
Yeah, I can ask if you want.
Yep.
So in the Dundo Investor, you had an example of a business you had to research to become competent. I think it was shipping barges. So my question basically is, in the context of that example in the book, when you're first starting out in the investment world, when do you recommend digging in to become competent in a business versus taking a pass? Does that make sense?
Absolutely. So I think the shipping company, at the highest level, shipping isn't that complicated. And I was intrigued about a few things I had read. So I said, let me dig in some more here to understand. So I believe the business was these are ships that were VLCCs, very large crude carriers. And at the time, there were 400 of those ships in the world. And so these VLCCs are specialized ships that transport crude. And so, yeah, I mean, I didn't think shipping was too difficult a business for me to get my arms around. I wasn't very familiar, or I wasn't familiar at all with crude shipping. But I was curious about it. So I said, okay, let me see if I can read up on this and understand how the business and the industry works. And it didn't seem that complicated to figure out. And, I was able to use a heuristic that one of my friends in commercial real estate had told me. And I realized that that same heuristic and that same mental model would work in shipping. And so there was an insight which I had gleaned, and I thought that that insight would work in this area as well. So in commercial real estate, especially if you're talking about tall office towers, 30, 50-story type office towers in large metro areas. Generally speaking, those office towers may take 4 to 6 years to get built or come to fruition from the time that the someone has the land and creates a plan and tries to get the permits. It might be easily 5 years before the building is ready. And generally speaking, what happens in real estate is that when the market is really tight and when rents are rising a lot of these projects get started because the economics look so favorable. And generally what happens is, because there's lemming behavior, all these towers get started at about the same time and they get delivered about at around the same time. And so you go from a very tight market to a depressed market because there's too much supply. So this 5 year or 5 to 6 year gestation period in office towers leads to booms and busts in commercial real estate. We don't see that same nuance in, for example, let's say industrial space or commercial warehouses and those sorts of structures, because there you could be done with construction in 12 to 18 months. So there, because the time frames are so short, you're typically able to turn on and turn off the spigot relatively soon versus while looking at what the situation is. But you're putting up a 50-story tower, you're already up to the 25th story. It doesn't matter what the market is doing, that baby's going to get delivered, and it's coming out, regardless of whether people want that child or not. That baby's coming out, and so that same. I noticed that when I was looking at the VLCC market, it had a similar attribute. So there are only 3 or 4 places where these ships get built, mainly the Korean shipyards. And if you wanted to get a new VLCC, you'd go to one of the Korean shipyards typically and put down a deposit. And in about 3 years or so, they would deliver you a ship. And if the queue was long, it might take longer. And so these shipping rates in VLCCs, I noticed, had very extreme fluctuations. They could go as low as $5,000 a day to as much as $200,000 or $250,000 a day. So there was a very wide range, way more than commercial rents. Commercial rents in office towers do not have a 50-to-1 variance in rents over even decades. But in the shipping business, you can see pretty large variances. So whatever I had learned about the office tower business, I realized that it was on steroids in the VLCC business. And the booms and busts would get even more exaggerated because of that huge variance. So these were some of the factors that made it interesting to look at that business. So it was really understanding the dynamics of how daily rates are determined for shipping crude oil, and how you couldn't instantaneously increase the fleet even if demand went up, because it would just take time. to build those ships, etc. So I think what you can do is, if you are curious, I think that learning about different businesses and learning about different industries and nuances is always been of interest to me. I love to kind of know how the world works. Whether we get to the point whether we can make an investment or not is the second question. So sometimes we can read or learn enough where we feel we've really got it nailed. We understand the dynamics that would drive that result. And just to go a little further, because there's so much great learning in that shipping example, is the company I was looking at the time is called Frontline, and they were the largest operator of VLCCs in the world at the time. I think the global fleet, was around 350 to 400 ships, and they had about 80 ships. And the unusual thing about Frontline was that 100% of their fleet was on the spot market. So there are two ways, if you are a ship owner, that you can run your fleet. One way is you can sign long-term lease agreements with, let's say, for example, Aramco or Exxon or whoever, some refiner, so that they would say, yeah, I will lease your ship at, $20,000 a day for the next 2 years, for example. And in that case, whether they're using the ship or not, or whatever's happening, you're getting paid. And so your cash flows are really stable. Or you could be at the other end of the spectrum where you're saying, I'm only willing to rent per voyage. And so when you have a ship that needs to go from Saudi Arabia to Louisiana, and that journey may take maybe 25 days or something, you can rent the ship for 25 days on the spot market at that time. So Frontline had their entire fleet on the spot market. They also had debt on their ships, but the debt was tied to individual ships. So it was like a mortgage on each ship, and it was non-recourse to the parent. So at the time I was looking at Frontline, shipping rates had collapsed, mainly because demand for oil had gone down, and shipping rates had collapsed to less than $10,000 a day, $8,000 or $10,000. And at those prices, they're losing money. They cannot make ends meet at that price. So when shipping rates collapse like that, there's a second nuance that kicks in. So I'm sorry I'm taking a little bit of time, but just to explain kind of how things work, because these are all things I learned when I was looking at it, is after the Exxon Valdez went aground in Alaska, there were a set of new regulations that came out around oil-carrying ships. And they mandated that all the new ships that get built needed to be double hulled. So all the ships that were built after the Exxon Valdez crash were required to be double hulled. And the ships before that Exxon Valdez incident were single hull. And in the shipping business, when you rented these ships, single hull ships, which still existed, they were older, rented for lower rates per day than double hull ships. But when rates collapsed like below 10,000, what that meant was there were too many ships. And so nobody was renting single hull ships because the delta between single and double hull disappeared. And so typically there were these maverick Greek owners of these single hull rust buckets. And they're sitting on this fleet and no one's renting it. And scrapping of those ships skyrockets during those times. So the ship owners look at it. So one thing that real estate guys do is they project present circumstances to infinity. If current rents are high, they believe rents will always be high. And the ship owners are even more extreme than the real estate guys. So if the shipping rates are $250,000 a day, they believe they will always be $250,000 a day. And they all go to the Korean shipyards and place a gazillion orders for ships all at the same time. Okay, so when the ship rates are low, like 8 or 10,000, all these Greek ship owners rush to all the scrapping yards and say, "Take my ship and give me the price of the metal," because they just assume they'll never be rented or whatever else and so on, and they anyway know that there are these maritime regulations that make it harder and so on. So what ends up happening when rates are low is the fleet might decline from 400 ships to 370 ships or 350 ships because of all the scrapping. Then when oil demand comes back up, now you don't have those 50 ships. So typically what you would see is that it would go even more asymptotic than Bitcoin. The shipping rates would go from 10,000 a day to 200,000 a day in the space of 3 weeks or 2 weeks. It would go really fast because literally you couldn't find a ship, right? So everyone's clamoring for them. So when I looked at Frontline, I did a very simple calculation. I said there was a website which would tell you what the selling price of these ships were. So I just looked at their fleet and said, okay, if you shut down the business and sold all the ships, what would you get and how much is the debt and what would you end up with and what's the stock price? And the stock price was, I think, $4 or $5, and liquidation value was like $8 or $9 per share. So I said, there's no way to really lose money over here because if all hell breaks loose, they can keep selling ships, and as they keep selling ships, they'll make more than the stock price. And so I put about 10% of the fund's assets into Frontline, and in a few months, it shipping rates started to go up, and it went up to like $10 or $11 a share. I had a very nice gain in a relatively short period of time, and I exited Frontline, patted myself on the back, and moved on. Then when I looked at Frontline, I think a year or two later, it was over $150 a share. And I missed that entire ride because, like I said, it went to the other end, which was euphoria. And of course, my whole thesis was around just something where I couldn't lose money, but I could have been a little bit more savvy about the fact that when you have these extreme compressions, you're probably going to see a pop on the other end. And I could have, for example, kept a small position or something, but such is life. So sorry to tell you more about shipping than you ever wanted to know.
No, that's good. I would like you to circle back around a little bit in talking about diversification. Obviously, in the academy, we're quite big on it. And then if you look at most of the money management industry, they've taken that to where folks hold, sometimes hundreds of names in a portfolio. How do you think about diversification? How many stocks will you hold? You mentioned Frontline, you had at 10%. How do you think about kind of portfolio construction?
Yeah, so I think at Pabrai Funds, we have never invested more than 10% of assets in one position. And typically that's our preferred situation. So kind of a 10 by 10 portfolio, if you will. But what I have historically been unwilling to do is cut the position back. So we have had situations in the past where two stocks make up 70%. And I don't lose any sleep over that. And so I'm not a big proponent of cutting the flowers and watering the weeds. Just not very interested in doing that. So the portfolios will tend to get more concentrated. And I would not make a change purely from the perspective of quote unquote risk management or anything like that. I would look at the business and look at the nuances around those businesses and see what made the most sense. In my personal portfolios, I rarely have more than 3 stocks. Many times I have one stock. And even in our foundation, we tend to be quite concentrated because there just aren't that many ideas that you can find that you understand well and are deeply mispriced and so on. So most people would not be able to sleep well at night doing what I did or doing what I do, you definitely have to do things that give you comfort.
One of the students, I think Mike McCarthy in our Kelley Direct program, had listened to an interview that you did and talked about how you focus a lot on India and emerging nations, and it's harder to find some mispriced securities in the U.S. And there were a number of questions that were put in of what is your view, on efficient markets? Is the U.S. an efficient market where we should only be looking at other places, or are there various levels of inefficiency? And maybe you could touch on some of that.
Sure. Yeah, I mean, I think it's efficiency or inefficiency is not directly related to specific markets. There are and there were times, and there will be times in the future when US markets will be very inefficient. I don't believe that the inefficiency that exists today in the US markets are leading to a lot of securities that are undervalued. I believe the inefficiencies currently in the US markets are in sectors which I believe are overheated and overvalued. So there are pockets where I think it's probable that things are overvalued. Since I don't short, that's just academic, it's irrelevant. So when I look at specifically looking for undervalued names in the US presently, those are few and far between that I can find right now. And especially I'm looking for significant discounts. So I'm not looking for something that's worth 10 and selling for 8 or something like that. I'm looking for something worth 10 and selling for 4. So that doesn't exist much today, but it has existed in the past and it will exist in the future. And different markets around the world are in different points in that cycle. So some markets, the whole markets are very cheap. And in others, there's just more inefficiency on both sides, undervalued and overvalued. So, so I think that other markets are being able to look into markets outside of the US could be of some advantage to an investor.
You mentioned a philosophy against shorting. I know. I think Addy had a question on that from an article he had read on the website that you had written a number of years ago. Addy, are you able to come on and ask your question?
Okay, thanks. Yeah, in one of your articles, you said when you look carefully at the economics of shorting, it makes no sense to take the bet. However, some advocates say that the use of short selling as a long-term strategy in combination with long position can help balance your returns. In other words, you make profit in both rising and falling markets. My question is, has your view changed in the light of this philosophy? Thank you.
If you look at the top 10 wealthiest people on the planet, top 20 wealthiest people on the planet, top 50 wealthiest people on the planet, I don't see any short sellers in there. And if shorting is such a great activity, why don't I see these awesome short sellers in the Forbes 400? Why don't I see them there? That list is dominated by people. It's dominated with people with two characteristics: people who are long only and people who are non-diversified. For example, my hero, Sam Walton and the Walton family, and so on, and or Bill Gates and or Jeff Bezos and so on. These are all long only players. So if you're mathematically inclined, on paper, it looks really nice that I can go long 10 stocks that I think are undervalued and then short 10 stocks that I think are overvalued and, create alpha and all of that. And there are some people who are very gifted at that and who can do very well. But the issue with shorting is that it comes with a need to be really good at risk management. let's say, for example, you shorted Tesla at $50 a share. So typically what a short seller would do if they knew what they were doing is each time Tesla went up 10% in price, for example, they would cut their short position by 10%. So by the time it got to 100 or something thereof, they're out in effect, right? That's how you manage the risk, because as it's going up in price, your losses are, magnified quite significantly. On the other hand, typically the way they manage it is that if Tesla goes down in price, as it goes down in price, they increase the short position. So if they're shorted 1,000 shares at 50, they at 45, they might make it 1,100, and at 40, they might make it 1,200. And so you're typically playing this game where you're doing this. And I think even the best short sellers, the way they measure their results, they would say, look, if the S&P long term has done 9% a year, and I have long term lost 3% a year, it's an exceptional result because I created 6% alpha. Well, I don't see how that gets you on the Forbes 400, other than by convincing people to give you fees for losing 3% a year. So shorting is just something, I have a couple of gurus, Warren and Charlie. What they say, for the most part, makes a lot of sense to me. They say specifically when they had companies that they believe were great short candidates, they were almost always right about the company, but always wrong on the timing. And so it's really hard to get both the timing and the direction correct. So it is so much easier to make money on the long side. The other thing is that if you're short, you got an umbilical cord linked to a quote machine. Okay, when the market's open, like I have no idea what's happening to my portfolio right now. I mean, I have no leverage, I have no shorts, and quite frankly, it's irrelevant what happens today or tomorrow or next month and so on. And even if I never got to see any stock quotes, it's perfectly fine. That is not how a short seller lives his life.
Very true.
Thank you.
Patrick O'Neill, one of our MBA students, wanted to know more just about how your process, you've started to identify a name and how you go through the research process, and specifically, what kind of sources of information do you find are the most impactful? Is it going through the Ks, the earnings calls, research reports? How do you go through your process, and what are the important items that you get the most out of?
Yeah, I mean, I think it depends. With each situation, it's different. I mean, sometimes there's a great write-up on Value Investors Club, and that'll get you quite a ways along, and then you can, dig through the company's filings and especially what they've been saying a few years ago about their business, maybe 5 years or 10 years ago, and versus what has transpired. So, do they underpromise and overdeliver, or vice versa? So, I think the idea is that it's kind of like it's a treasure hunt in the sense that, or it's a jigsaw puzzle more, where you got some understanding of a business, have some thesis about why this could be interesting, and then you're looking for evidence that uh, confirms and denies that, and just keep absorbing. And I'm always looking for a flimsy reason to stop research and be done and move on. And like recently, I was looking at a company and it looked interesting, but after about 3 days of digging, it was like, yeah, this is not interesting. We're moving on. But the good news was I learned a lot about the industry. I learned a lot about the company and the CEO. So those are all good things. It gave me a good amount of data and knowledge, and I enjoyed the process.
How long do you typically hold a stock?
Well, there's a quote which I ran into last year, which I wish I had run into 20 years ago, which is, I think, a quote by Thomas Phelps, who wrote 100 to 1 in the stock market. It's a great book he wrote in 1972, I think. And I can't recall the exact quote, but basically he said to the effect that every sell decision is in fact an investing mistake. Anytime you sell, you're in effect acknowledging that you made an investing mistake. So utopia would be that you made an investment that you could hold for a few decades, and that would be compounding at a solid double-digit rate over that period. And you didn't have to do anything. You just sit on your ass and the company just kicks ass for you. And such businesses do exist, and it's easy to identify them in hindsight. It's a lot harder to identify them before that's happened, but that's the holy grail. So my holding periods, I went through quite a significant change in my thinking last year. I think for a couple of decades, my thinking was like with Frontline, you buy it kind of half off, and then you double your money and you move on and soak, rinse, and repeat. And that is fine. It can certainly be a good way to make a buck, but it is tax inefficient, and you're on a treadmill of activity. And even in the case of Frontline, I missed the big run. I captured my double, but I didn't capture the big run. And my thinking now is much more around compounders. It's around questions like, what is the destination of this business in 10 or 20 years? What does this business look like in 10 or 20 years? And of course, a business like Frontline, you just couldn't get there. The only thing you could do with a business like that, from my point of view, was play this arbitrage game of liquidation value versus the stock price. It'd be very hard to hold it on earnings because it was so volatile. So I think the holy grail is to find these compounders that the rest of the world has not figured out are great compounders yet. And then you just sit on your ass. So that's the game plan.
That sounds a lot to me like kind of the transition that Buffett kind of had in his career, where he started out kind of looking at nets from the Ben Graham days, and then kind of started transitioning into more of that. Obviously, when you're on the first side, where you're trying to get something valued and buy it at 40, 50 cents on the dollar, that seems to be much more kind of formulaic than finding that. So how has your process had to change? What kind of valuation discounts? Because obviously those companies may not get down to 40, 50% as often as a commodity company might. So how do you go about, how has that philosophy changed how you do things?
Yeah, I had dinner with Charlie this past weekend on Saturday at his place, and he looks great and doing well. And many times when I see him, he will say XYZ company is a cinch, or ABC company is not a cinch. And like, for example, if you asked him about American Express, for example, Charlie would say it's not a cinch. But if you had asked Buffett and Munger about American Express maybe 20 years ago, they would have said it's a cinch. It's what he means is that the odds that you would have something destroy that franchise was just so infinitesimal at that point, which is not the case in their minds today. So it's a very good business. It probably does really well. But in the definition that he uses of a cinch, which is a pretty high bar, he doesn't think it's a cinch. So it's very funny when I have these conversations with Charlie, I'll ask him, is it a cinch? Charlie, no, this is not a cinch. This is a cinch, blah, blah. So once Charlie says something is a cinch, and if it's sitting at a cheap price, I know all I got to do is back up the truck. and life is good. So one thing that changes, between when you're looking at these 50-cent dollar bills versus these long-term compounders is you need to get as close as possible to a cinch. So I haven't asked Charlie this, but if I were to ask him, Charlie, is Costco a cinch? He would probably say, yes, Costco is a cinch. Okay, because it's very hard to imagine forces that would destroy Costco today. And in fact, each time they open a store, the moat becomes that much more valuable. Each time they add a member, the moat becomes more valuable. So on both sides, you've got this deepening moat effect taking place every day. So the question, I think, when you're looking at these long-term compounders is a fanatical focus on cinches or near cinches, where you need to, if you're not going to sell the business for a very, very long time. Capitalism is brutal. 99% of businesses that get started won't even last 10 years. Even the Fortune 500 companies won't last more than a few decades. Eventually, almost all of them will die. And so trying to find the exception to the rule is in many ways a fool's errand. But that's also the path to getting to the promised land. And so cinches are very important. Another mental model, which I think is really interesting and important, is there's a good friend of mine, and he used to work at a multi-billion-dollar fund. And many years ago, maybe this must be more than 15 years ago, he was the analyst looking at American Tower, the company. And the company had organized a few analysts at these large firms to visit their headquarters. And they were going to have some presentations for maybe an hour. Then they were going to have lunch, and then they were going to have a golf game with the CEO, CFO, and a few other people. So he showed up a little early, and he was sitting with the CFO in his office. And the CFO had his feet on his desk. And it didn't appear to my friend like the CFO had anything to do. He was just sitting there relaxing. So my friend asked him, don't you have deals to do? Like, you're just sitting here. Don't you have things to do? He said, because they're a very acquisitive company. They buy lots of towers. That's how they grow. He said, look, anyone who owns a tower has our phone number. And anytime they want to sell a tower, they can call us. And we already know what we're going to pay for the towers. So we just sit here, the calls come in, we give them our term sheet, and life goes on. And then we keep, acquiring more and more towers. And each tower is getting more and more valuable over time because they're hanging more and more tenants off it. All of this stuff, right? So there was another company called Bandag, which was in Iowa, which is, retreading tires. And Chuck Akre had visited their headquarters a few decades ago. And again, when he went in to see the CEO, he saw the guy had his feet up on his desk. And so if the CEO has his feet up on the desk, generally speaking, that's a kick-ass business to invest in. So the first question to ask is it a cinch? Okay. And like Amex is not a cinch and Costco is a cinch. So that's a high bar. The second question, is this a business that the guy can run with his feet on his desk? And most businesses cannot be run that way. If the guy puts his feet on his desk for half a day, in 3 months, he'll be out of business. That's the reality with most businesses. And then there was a third one. What was I was thinking of? There's a third point I was thinking of. It'll come to me. Let me think about that. But I was just thinking that, so if it's a very different way of thinking about it, right? One way of thinking about it is these 50-cent dollar bills, blah, blah, blah. The other way is you're going after these long runways. And basically the way I look at my portfolio now, it's a museum. And eventually what that museum has to have is only Cinches and only feet on desk businesses. Let me be very candid with you. I am not in the promised land right now. I only have two businesses that I can think of where they are Cinches and the feet are on the desk. But two is not bad. The idea is hopefully in the next few years, all these Mickey Mouse businesses go out of the portfolio and they get replaced with these awesome businesses. And the third question to ask is, what is the destination? So if I look at a business like Costco, they just entered China. They opened one store in China and the store got mobbed. They had to put restrictions on how many people could come in because they just couldn't handle it. So if you fast forward 20 years, what does Costco look like? And I don't know what it looks like, but it's possible China has 1,000 stores. Could easily be within the realm of possibility. There's probably more than 160 or 170 countries where Costco has no presence. So could they have a presence in 10 more countries in 20 years? Maybe. So what does that business look like in 20 years? It probably looks a lot better as long as the culture stays set and the core DNA of Costco remains intact. So that's a business that, at least looking at it in 2021, looks like a cinch with a great destination. So the question to ask yourself is, what is the destination? If you ask the question about what is the destination on Frontline, your head will go for a tailspin. You're going to deal with all the Greek owners and figure out what they're doing, and then you might get some ideas. So that's the thing: Cinches, feet on the desk, and awesome destinations.
So Mohnish, then if you're looking at, say, Costco and that checks those boxes, then are you trying to value it on where it's at currently? How much are you giving it for its destination? How do you think about
Yeah, so the problem for someone like me is I want to have my cake and eat it too. So I want Costco at 3 times earnings. And it's slightly above 3 times earnings. Let's look at what Google says Costco's trailing multiple is right now. So the trailing multiple, according to Yahoo, is 36. 36 is not bad for a kick-ass business like Costco. But for a cheapskate like me, at 15 times earnings, you lost me. I mean, I would go above 3 for Costco. I might be interested to even look further at, low double digits. But when you get past that, you lose me. So such is life.
So Mohnish, Alex Galt, one of our MBA students, in one of your interviews, you talked about kind of a pre-investment checklist you go through, and he wanted to know kind of what items or questions might be on that list. Can you expand on that? Maybe is it a cinch is the first couple three. Could you go through kind of some of those attributes on your checklist and how those came about?
Yeah, so the checklist is a living, breathing document. I just recently added these 3 questions to the mode section of the checklist. Is it a cinch? Are the feet on the desk? Is the destination awesome? Right? So you already have 3 out of the 170 questions already. The other 167, I'm not inclined to list here right now. But I would say that it's not that difficult to come up with a good checklist. All I did was I looked at how great investors lost money. Like I looked at businesses that Buffett and Munger and others invested in, where the end result wasn't great. Then I looked at, were there were there things known before the investment was made that could have prevented you from making that investment? So the checklist basically asked the question that, you know, for example, Buffett made an investment in Dexter shoes and it did not work out well, and they got decimated by foreign competition and cheap Chinese labor. So, for example, the checklist question would be: is this a business that could be negatively impacted by cheap overseas labor, for example? Right. So that's a checklist question that would come out from that. And when you look at a business like Amex, the answer would be no. Even if you look at a business like Costco, the answer would be no. But there are definitely manufacturing businesses in the US where you would want to ask that question and figure out what the realities are.
So, Mohnish, in your book, you talked about kind of these infrequent big bets, and I think it's a form of the Kelley formula. Do you use the actual Kelley formula, or did you just kind of figure out 10% is kind of as much as you would put for your customers? How do you use the Kelley formula when you're trying to put together the portfolio?
Yeah, in my book, if I were to ever do a updated edition, I would take out the Kelley formula. The Kelley formula is actually a mistake in my book. Basically, it does not apply to making stock investments because it really works if you get to make the same bet 10,000 times. So if you knew that heads was 51% and tails was 49%, and you were allowed to participate in 10,000 coin tosses, well, you would bet on heads all the time. And then the formula would allow you to determine that if you have $1,000, how much to bet each time so that your bankroll doesn't disappear and you optimize the upside. So the Kelley formula works if you have those sorts of nuances in betting. That is not the nuances we have in stock picking because we don't get to make the same bet over and over. So I would just disregard everything related to the Kelley formula as far as stock investing goes. And the 10% just came about because it just felt comfortable to me. When I came up with it, I said, this sounds like a good diversified portfolio. I think what I've come to realize is that in my personal portfolio, I'm fine with even higher concentrations, but I really have to know the businesses extremely well. With other people's money, I think the 10% is fine from my point of view.
So, Mohnish, how do you go about setting kind of the intrinsic value that you come on? Do you use a DCF? How do you go about that? And then I think in your book you talked about using some scenario analysis and what it would be valued under different scenarios. How many scenarios kind of make sense if the business is simple versus complicated?
Yeah, I think it depends. Again, depends on the business. I mean, if you were looking at Costco, you would need to have some range of future stores, future memberships, future kind of profitability per store, all those sorts of metrics. So you'd have to have some numbers along those lines in your head. Then you could backtrack from that into what might be a reasonable price to pay and then what return you might expect. So I think with each business, it is different. I think it just depends on the business and depends on what's going on with the company. And so it's the analysis varies by the nature of the business. And these numbers, and I'm not a big fan of DCFs. I think anytime you reach for Excel, I gave a talk on the 10 Commandments. Moses kind of made up the 10 Commandments. The real 10 Commandments, one of them is thou shalt not use Excel. And so if you find yourself reaching for Excel, it means there's a problem. Like, I know that if I can get Costco at 9 times earnings, I don't need Excel to tell me I'm going to make money.
Have you do you use the same hurdle rate for all the investment and try to do a risk control just through your research process? Do you change it? And has your hurdle rate come down kind of as interest rates have come down, or are you a believer in more of a absolute hurdle rate for your investments?
Well, the hurdle rate also has changed quite a bit with this approach of buy and hold forever. Because if you take the approach of holding a business forever, I mean, let's say, for example, Costco went to 9 times earnings and I bought it, etc. And then in a few years, it's at 40 times earnings, for example. My take on a business like that would be that just leave it alone. Don't sell it. Even though it is probably true that the returns from that 40 times earnings number aren't as spectacular as they were from the 9 times earnings number, and the risk is higher. But the idea is that if the family that owned Costco probably would not be looking at that multiple and selling, my nuance needs to be like the family. So the key question is the business getting better? Is the moat getting deeper? And is the company becoming more valuable? And if those answers are yes, then I just leave it alone and not worry too much about what type of return it would generate in the future.
So, Mohnish, have a question from Rohan Malpur. He's one of our MBA students, and he talks about some of your philanthropy work and how do you apply some of the investments from or tenets from your investment? How do those carry over into the social work? How do you do a return on investment if you're looking at philanthropy?
Yeah, so I think when I first started to look at, giving back, because I was seeing that if the compounding works, you end up with more money than you can use, and giving it your gene pool isn't the smartest thing to do. You're actually hurting them more than they're helping them. I was very disappointed when I looked at a lot of charities because I wanted to find a charity that I could give money to. And I found that either they had many different initiatives, which itself is a problem, because if you have 3 initiatives as a charity and you measure the outcomes, and one is better than the other 2, well, then the following year you should be one initiative, put it all into the one that has the highest return for society. But that's not how charities function. And the other thing that was, the thing is that if a business does not do well, does not service its customers well, it will eventually go out of business. But if you are the Rockefeller Foundation and you have a $1 billion endowment, for example, $1 billion in assets, the law only requires you to spend 5% of that in a year. So they'll spend 50 million. And it doesn't matter what happens to the 50 million, whether it helps society or not. The next year, the 950 million would have probably grown to again over $1 billion because of the investment returns. Probably 4 or 5% is not that hard to get. So you again have $1 billion, you again spend another 50 million. You could keep spending 50 million stupidly a year for 50 years. And the engine would keep going. A business like Costco, if it doesn't deliver value to its customers, in a few years, it will disappear. So there is no feedback loop in philanthropy that auto-corrects. Capitalism works because of the creative destruction. In philanthropy, that's not the case. And so on top of it, what happens is the principal Rockefeller created the wealth. Now it's a bunch of agents who are running everything. So what do the agents care about? Well, the number one thing they care about is getting paid. So they have nice jobs. They get paid well. Everything is stable. They're not going to spend the whole $1 billion in 1 year. They'll just keep rolling out the 50 million. And nobody, put out a glitzy annual report, show some pictures of some good things that you've done, and life goes on. And no real measurements of impact. So what I did when I started Dakshana was that I did not want to go down that path. I wanted impact to be known and measured. So most endeavors in philanthropy do not lend themselves to easy measurement. I mean, if you're distributing needles in some inner city to, help people not get HIV and such, it's a very good initiative. The measurements become much tougher. What was the impact? How much did this help or hurt or whatever? Those things become really hard. So what I decided is that I would limit myself to programs that lent themselves to easy measurement. So I inverted the problem. So I said, even if an initiative is really good, if it doesn't lend itself to easy measurement, we're not going to do it because then there's no feedback loop. And so Dakshana went down a path of, education was near and dear to me. I saw the multiplier effect it could have. And then we have a system where we get independent third parties giving us a report card every year. And that report card is very valuable to us. I pay a lot of attention to it. Our management teams pay a lot of attention. And now recently we put in incentives where a significant portion of our faculty comp and all of that is based on the results that they don't control. And so I think those are important things for nonprofits to look at and consider.
We had some different questions kind of about behavioral finance and so forth. One of them came from Max Kim, who wanted to know if you could maybe talk about maybe a large setback you've had in investments. How did that impact your confidence, and how does your process keep you from overreacting to something like that and still keeping with your discipline?
Yeah, so there's a saying, if wealth is lost, nothing is lost. If health is lost, something is lost. And if character is lost, everything is lost. So the question relates to wealth being lost, which, quite frankly, in the large scheme of things, isn't that meaningful. So it is in the nature of investing that if you make 10 investments, at least 4 of them probably won't work out the way you expected. They'll work out worse than you expected. And it could be 5 or 6 out of 10 that work out worse than you expected. So anytime we're trying to project the future of a business, it's not an easy endeavor. The future, I mean, who could have predicted we'd have a pandemic? It just came out of the blue. So, and if you had asked me once we knew we had a pandemic, what stock prices would look like a year from now, I would say they'd look terrible. And I'd be completely wrong. So the way the future unfolds is so different than the way we might rationally think it ought to unfold. And so I think that having investments not work out or having investments go south is just par for the course. So obviously, I would not like to lose money and not like to lose money on investments, but it has happened. It has happened many, many times in the past. In fact, at Pabrai Funds, I've had several zeros where a company has gone bankrupt and we collected next to nothing versus what we invested. I'd made an investment in a mortgage company in 2007, 2006, 2007, Delta Financial. I think $50-60 million investment went to zero. We used to have an investment in a zinc recycler, Horsehead Holdings. Significant investment went to zero. So, and then countless investments which either went flat or declined somewhat. Didn't have a zero, but they might have been down 20% or 30% when we sold. So that's happened a gazillion times. And so this is all par for the course. I think all we can do is have discipline and process. And one of the reasons why we have 10 bets is so we can ride these out. And so that's, but I think for me personally, it doesn't really rattle me or anything like that. I just, I'm not wired that way.
So we had one question on what do you think the best trait is for an investor to have, and what is the most kind of valuable skill that they can try to develop?
The single most important trait for an investor to have is extreme patience. So the time frames in which businesses go through change is very different from the time frames with which your brain processes information. So business change takes years and decades, and your processing time is in seconds or minutes. And so if you are the kind of person who loves to watch paint dry, like especially a wall that's just been painted white and you can just sit there and watch that wall, you are ideally suited to be a great investor. If you are the kind of person who thrives on inactivity, of doing nothing, it's great. I think you can do very well. It reminds me of a Seinfeld episode. Seinfeld might be past the genre that the viewers here have looked at.
I'll get it anyway, Mohnish.
But Eric might have seen a couple of episodes. So there was one episode where Elaine is on a flight with her boyfriend, and her boyfriend is just looking at the back of the seat in front of him. He's doing nothing. His eyes are open. He's just looking at the seat back in front of him. So Elaine asks him, "What are you thinking?" And like all of us men, he said, "Nothing." So she said, "No, what are you thinking?" He says, "Nothing. I'm just looking ahead." Yes, but you have to be thinking about something. By the time the flight ended, they had broken up. She had broken up with him. Okay. And in reality, he was so well suited to being a great value investor because he was so happy just looking at the seat back in front of him. He was in bliss and she couldn't handle it.
So what was it? Putty, was that the character's name? I think.
Yeah.
The value investor. Putty is a value investor. All right. Oh, so obviously, I think it was you and Guy who had the lunch with Warren Buffett. So couple questions on that. Do you think it was worth it? Number one, and what was the main takeaway you got from having lunch with Warren Buffett?
Other than I think
Charlie
that
hear if they're a cinch or not.
Well, I think my only expectation for bidding for the lunch and meeting Warren was to just thank him. I felt like I had used his intellectual property and was earning a livelihood with his intellectual property. And it was a way to maybe kind of pay at least part of the tuition bill. And to look him in the eye and just say, "Hey, thank you very much. It's been exceptional." So I didn't really have any expectations beyond that. I went for the lunch with my family. My daughters were at a great age at that time, 9 and 11, which is a good age. And Guy Spear came with his wife. And so we had a wonderful lunch. I think the first thing Buffett did when he got there, he said, "Look, I have nothing on my calendar all afternoon. And so when you guys get sick and tired of me, I'm happy to leave. But I don't have to be anywhere. So it can go on as long as you want." And then very quickly, he tries to put you at ease, and you think you're just having lunch with your grandfather. So yeah, the lunch was on many levels spectacular. I think that the takeaways from the lunch, I have a decent friendship with Warren now. It's been 13 years since we met for lunch. The lunch also led to a friendship with Charlie and to many other relationships in my life. So it's been really spectacular, and I think even the takeaways have been. There were so many takeaways. I think after the lunch, I made some notes. I think we asked him like 55 different questions that we could recall. So, and Buffett tries really hard to make sure that you feel like you got a bargain. So, for example, he told both my daughters who were sitting on both sides of him that the single most important decision you will make in your lives is who you decide to marry. And they are now young ladies and they remember that message quite well. And I don't think that message would have resonated as much if I told them that or their mom told them that and so on. So they heard that and they appreciate that. And I think I think, will make sensible choices on that front.
Sorry, I'm laughing. I have three daughters who are transitioning from, in the college and young adulthood. So, yeah, it'd be good to have a surrogate grandfather give them good advice, right?
Yeah.
Mohnish, there's been a number of questions just on kind of career advice and so forth. There's a couple folks who would love to kind of start a fund at some point. And could you talk a little bit about how you got your fund started? How you attracted investors, how you set it up. I know you have some thoughts on fees with how you did it, similar to the Buffett partnership. Could you expand on some of those for the students?
Sure. Yeah. Pabrai Fund started in 1999, and I really wasn't planning to start a fund or anything. I had done quite well investing my own money. I think a million had turned into 12 or 13 million in about 5 years, from 94 to 99. So things had gone quite well, and I enjoyed that whole process and such. And I used to give my friends stock tips. So they approached me in '99 and basically said, "Look, this stock tip business is random. Sometimes we don't see you for a while, and we don't know whether to buy or sell or whatever." So they wanted to give me money to manage, and and I wanted to make sure that if I took their money, that I wouldn't lose my friends. And so I wanted to set up a mechanism by which their downside was very limited. And so actually, when Pabrai Fund started, it really started as a hobby. I had no plans to grow and scale it. I just thought it's a little $1 million pool of capital of my friends, which is easy for me to invest that when I'm making my own investments. And so I actually guaranteed their principal, and I also guaranteed them 6% a year. And above that, I would take 1/4, they would get 3/4. And about 15, 16 months into the funds, we had about close to 3 million in assets. I decided, it would be good to actually run it as a real business. And I couldn't do that with these guarantees and such. It wouldn't scale. So I requested my friends that we would make an amendment and we would take out the guarantees. They said, no, 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 we like the guarantees. The guarantees are great. So what I did is I set up another fund, and then I just told them this fund is going to close down, and the other fund has the same rules except there are no guarantees. Principal and 6% is not guaranteed. So they all moved over then. When the funds were, when they had no choice, they all moved over there. And so that worked out fine. And I would just say this, that, Buffett says that you could be a leper in the middle of the Atlantic in a rowboat, and they will swim to you in shark infested waters to invest with you if you deliver above average returns. So if you have had a history where you've done well, and it's a auditable track record, I think that is the key to attracting assets and getting a fund business off the ground. So I think some prerequisites to get a fund business off the ground is, number one, if you're good at it, you should already be independently wealthy. Number two, you should have done quite well had a good track record, etc. And then beyond that, I think the friends and family should be very willing to have you manage some of their assets. And then once that's going, then others should have an interest as well. So it's almost automatic if the pieces are in place. And it's very uphill if those pieces are missing.
So, Monish, a lot of the students, obviously, they're early in their careers. There's a lot of noise about how things, how one should go about the business. How should they think about developing their own investment strategy as they work through the business?
Well, I think the best way to learn is to actually have a brokerage account which has a meaningful portion of your assets. And you start making investments when you have high conviction. And you make the mistakes and you learn from the mistakes and you keep going. I think that's how you get going. I think you cannot do this on an Excel spreadsheet with some hypothetical portfolios. It has to be real, and it has to be real with meaningful portion of your assets.
What someone wanted to ask, kind of in your career, what was kind of the biggest mistake you made in your career, and what lessons you learned from that?
Well, I mean, I think my career has had a lot of left and right turns, and for the most part, I think the journey has been very good and very rewarding. I think the one mistake I made a few years back, I think in 2014, is I had the idea to set up a holding company and to acquire insurance businesses and then, invest and have float and all of that. And I did set up that entity. We did raise more than 150 million of capital. And then we bought an insurance company. And then I realized it was all a mistake, that there were a number of things that I was learning that I knew that this would not work out as I had planned. So then I made the decision to unwind and salvage and get back the capital. And thankfully, we were able to sell the insurance company for a little more than we bought it for, which was good. And we've returned most of the capital back. And I think that whatever is left, I think we will return more than we took in. So the end result for the investors is not going to be great, but there's no loss of capital. So I think that's anytime I make a mistake in investing where there's no loss of capital, it's a home run. And so I think in recent years in investing, that would be but I also learned a lot from that whole experience. I learned a lot from actually owning an insurance business and actually sitting in the board meetings and looking at claims and really got a great understanding of the business. So I think from a learning point of view, it was exceptional.
Okay, great. I know we're coming up close to the end of our time, but uh, I'd love for you just any kind of broad career life advice for the students, and any closing statements or thoughts you might have.
Yeah, well, I think IU is a great place. I think you guys do a great job of sending forth. I think the Kelley School does a exceptional job. I think that when I was a student in early 20s, I really had no clue about many things, including what to do and so on, kind of drifting through life, if you will. I think the key is that you go to work for someone you like, admire, and trust. That's what Buffett says, focus on. So the normal tendency for students finishing school is to go for name brands. The large name brands look great, And those name brands are also great to talk to with your friends. Hey, I'm going to work for Alphabet, or I'm going here and there, which is fine. But I think a better way to approach it is to ask yourself what you really like to do. And if you could find somebody you really admire that you go to work under. So more than the great brands, what matters is who are the people you would work for and who are the people you would work with. And those are important things and the kind of work you would be doing. So the focus should be not so much on what would look good on a resume, but what would allow you to maximize your potential and accelerate your learning. I think that's really the key.
Great advice. Thank you so much for your time today, Mohnish. I didn't realize you had been on our campus before. We'd love to get you back to Bloomington sometime, back in the Midwest. But thanks so much for taking the time today to talk about your investment philosophy and process with our students. It's really appreciated.
Thank you, Eric. Looking forward.
All right.
Bye.
Thank you again. All right. Bye-bye.
Thank you.